Welcome to the Alluvium Foundation Nature Repair webinar. Before we get started, I'll just show a couple of slides showing the link to the Financing Nature Repair Literature Review, which is being launched at this webinar. And then I'll show a couple of slides showing our speakers for today. You can just pause and read those bios. Thank you. Well, everybody, we might get started. Welcome to the Nature Finance webinar. You're in the right place. People are pouring in, but what I'll start with is an acknowledgement of country. So I'd like to acknowledge the traditional owners of the land, sea and waters where we all are. I'm on Wurundjeri country and Kulin Nation. We acknowledge their continuing connection to culture, country, and pay our respects to elders past and present. And we look forward to reconciled and prosperous future for all. My name is Ian Rutherford. I'm the chair of the Alluvium Foundation. Now, the Alluvium Foundation is a not-for-profit organisation associated with the Alluvium group of companies. It's targeted at facilitating deep discussion about complex topics like nature finance. The Alluvium Foundation asked the University of Queensland School of Business to prepare a report on nature finance. And the rationale for that was the emphasis that's been put on nature finance under the COP15 arrangements, the Kunming protocols, the Australian government. There's a lot of emphasis and a lot of hope that private investment in nature will help the things we're all passionate about, which is nature and biodiversity. So I'd like to welcome you to this webinar, which is being recorded. Everybody online will be sent a copy of the recording. And I'd just like to introduce our the person who's going to manage the event today, and that's Associate Professor Jacquelyn Humphrey, who is also an author on the University of Queensland report. She's the head of finance discipline at the University of Queensland Business School. Over to you, Jackie. Thank you.
Thank you so much, Ian, and good afternoon, everyone. Delighted to be here. I'm joining you from Mianjin, where we are on the lands of the Jacquelyn Turrbal people. Thank you, everyone, for joining us this afternoon. Before we start, just some housekeeping about how the webinar will run. So we're going to hear from 3 speakers after myself, and there will be time for Q&A at the end. So if you have questions, please can you put your questions in the chat box? So that's in the chat box and in the Q&A. I'm in the chat box function, and we will do our best to answer the questions during the Q&A time. At the end, I'll be moderating those and looking for themes and so on. Thank you also to everybody who sent in questions beforehand. We have read through all of the questions that were sent in, and we're going to try to address those through the presentations today. But if you still have burning questions that were sent through and we haven't addressed, please feel free to put those in the chat, and we'll try to get to them towards the end. So today I'm very delighted to be joined by our 3 very distinguished speakers. So first of all, we have Lucas Dixon, who is a researcher at UQ Business School, and he was a co-author of the Financing Nature Repair report that we are launching today. We also have Sasha Courville, who is a principal consultant with Nature Capital and Climate and part of the Alluvium Group. And finally, we have Simon O'Connor, who wears many hats, but amongst other roles is a non-executive director at Bank Australia and a member of the Federal Minister for the Environment's Nature Finance Council. And you would have seen full bios of our speakers in the invitation that was sent to you as well. So today we're here to talk about nature finance. So I thought we would start by talking about what do we mean by nature and what do we mean when we tack finance onto the end of that. So very briefly, nature can be defined as all living and non-living components of the earth that are not created by humans. So land, water, climate, ecosystems, natural resources. You might also hear the term biodiversity and wonder, so what's the difference between nature and biodiversity? Well, biodiversity or biological diversity is really talking about the life component of nature. So Biodiversity is a subset of nature, living components, and also their interactions in the ecosystems. So what do we mean by nature finance? Very simplified, how finance can be used to protect, restore, and or manage nature. Or perhaps we can say, how can money be attracted from financial markets to address these issues? And that's what we're really going to be digging into today. So as Ian alluded to, at present, public finance, so public finance, so that's domestic government funding and development assistance, is the main source of financing for nature. So that constitutes about 73% of total funding globally, so really the lion's share. And we know that there is a significant gap or deficit in funding for nature. So the United Nations Environmental Programme estimates that funding would need to increase fourfold by 2030. So there's a huge need for the private sector to come to the nature finance party. As Ian said, the Alluvium Foundation commissioned UQ to write a report looking into financing nature repair. So Dr. Lucas, Dixon and I did an extensive review of more than 75 pieces of research by governments, intergovernmental organisations, non-profits, consultants and academics. The report covered views from many different disciplines, and we took a global perspective, not an Australia-specific perspective. So specifically, we looked at the need for private investment, financial mechanisms to close that funding gap, and barriers and enablers of private investment in nature repair. You would have received a link to the report in your reminder to this event, so please feel free to download the report. It's freely available to you. I'm now going to hand over to Lucas, who will provide an overview of what we found. Over to you, Lucas. Thank you.
Thank you, Jackie. I'm just going to share my slides. I believe I'm the only one with slides, and once I start talking, you'll see why I've provided slides, but I really think the other speakers will be super engaging without slides. So just want to double check everyone can see the slides. Yep, I got a thumbs up from Simon. That's great. So here I'm on Cubby Cubby land in beautiful Moreton Bay. Really pleased to be here. So thank you, Jackie, Ian, the Alluvium group, and it's great to be here with Sasha and Simon as well. And thank you everyone for joining us. I'm going to take us on a whirlwind tour of the UQ report, focusing on understanding private finance and the flow of money to and from nature, as well as the barriers and opportunities. Won't be able to cover everything, so there'll be plenty to dig into in the report. So who can finance nature repair? Apart from governments, we have private institutional investors. These are investment banks, pension funds, insurance companies, and large asset managers, and they invest funds primarily for other entities. They're motivated to generate a financial return for their investors and also motivated to reduce risk to their portfolios. We also have what we call supporting institutional investors. These are development banks, environmental trusts and funds, sovereign wealth funds, and these de-risk newer projects by offering initial loans, insurance, technical and accounting assistance, and it makes these projects more attractive to institutional investors and venture capital as they mature. We also have retail investors, individual non-professional investors who invest their own funds, or we might say they're also clients of institutional investors, and to some degree we all are if we've got a pension or those kinds of things. We also have companies who may invest in nature repair for many different reasons. What are the current nature repair flows and what are they projected to be? So I guess we should first start by talking about how can finance be beneficial to nature? Well, money can be directed away from nature harming industries, organisations or projects, maybe through redirecting government subsidies, and this reduces the need for as much funding in nature repair. Or it can be directed towards sustainable or nature protective industries, organisations or projects, and our focus today will be here. So if we look at the 2019 estimated flows, a lot of it has been coming from government, domestic budgets, tax policy, those kinds of things. Then we see smaller contribution of offsets and credits, which I'll talk about in the next slide. and natural infrastructure, such as naturally occurring or engineered natural environments that provide clean water or flood control. It may be paid for by different entities. We have green investments, developmental assistance, sustainable supply chains, and philanthropy. But as we can see, if we look at the 2030 projected flows or the opportunities for growth, the government really sort of flatlines as far as their level of growth, and things like offsets and credits and green investments see a lot of opportunity for growth. So I'm going to focus the rest of the presentation on these two avenues, but of course there's plenty to look at in the report. What are offsets and credits? They're tradable units representing a verified gain to nature or biodiversity. So the amount of habitat restored, the quality of that restoration, species populations protected, and this includes biodiversity related carbon credits. This allows developers or other impact causing entities to compensate for biodiversity impacts. This could be mandated or voluntary, and these offsets, these credits can be created, bought and sold in markets. So I'd direct you to the Australian nature repair market if this is something you're not familiar with. It's new, fairly new, and it helps facilitate the trading of these credits. So here's an example. Let's say a landowner, a conservation organisation or a company undertakes nature conservation or restoration. This can be converted into credits on a registry. Let's say a developer, maybe a road, mine or housing estate, they are often causing some kind of biodiversity loss. And so a condition of approval for these projects could be a developer offsets the loss by buying credits that provide funds to ensure there's no net loss to these natural resources and perhaps a net gain. Although I'm sure the sort of skeptical among us may say that, yeah, that's maybe not a net gain, but maybe at least sort of compensating and getting that balance. So then a developer buys required credits, and that can benefit those on the supply side back at step one there. And of course, it also leads to at least no net loss of nature or biodiversity, or perhaps a benefit to nature. But of course, like I said, the critique is that this might give businesses a social license to do what they want to do with nature, and but it is seen as one of the most viable ways to scale up private financial investment, because it's a market-driven approach and it's speaking the language of private investors and you know, money flows. So let's have a look at another type, green investments. This is equity. And we could think of equity as ownership, so ownership of a company or a project, or shares in one of those things, exchange traded funds. And then we also have debt, so lending money, or lending sometimes skills and technical assistance. So this could be bond creation to fund a project, or purchasing bonds, or giving loans to fund nature projects. And the return on investment here comes from an initial principal that gets returned at some stage or over time, plus interest. So these are two of the major growth opportunities, but there are barriers to this kind of private financial investment. It's the free market. And so what are some of these barriers? First of all, the complexities of measuring nature harms, gains, and return on investment. So nature is complex and varied, making many aspects of nature harder to quantify and measure. Though this has been achieved with carbon and forestry to some degree, but the way this is measured tends to be in tonnage or area. And this means that, you know, the gains and losses here might be a little easier to quantify, whereas ecosystem health is a complex, interconnected set of systems, so it might be more complex and harder to measure than things like carbon. But there's opportunities here for collaboration between measurement experts, environmental experts, and community knowledge holders. We will require these specialized and very sort of dependent in a way measurement approaches. An example is South Pole's Eco Australia Credit. They've created an Australian biodiversity unit. It's a standardised unit that represents 1.5 metres squared of protected land, measuring biodiversity outcomes in Australia, and it's an internationally verified carbon credit. So let's move on to looking at assessing risk versus reward for investors. Again, there's a complex set of stakeholders that need to be involved in environmental projects, meaning that projects might take longer to mature and see a return on their investment. And this longer time frame generally means more risk of unpredictable setbacks. And these kinds of setbacks are the things that are factored into investor decisions. And that means that these projects are often classed as higher risk and lower reward. So the opportunities here, the enablers might be, again, come back to investment from these supporting institutions in immature projects, as well as public-private partnerships. This is where universities also play a role. And this initial investment de-risks investment for other investors coming at a later date. It provides more attraction, I guess, to private investors. Now, there are market-based approaches like hedging via derivatives that can reduce exposure to market fluctuations. There's risk pooling, where you bundle funding for smaller projects together in something like a bond, which spreads out that risk. And so we're talking here about things like standardization and institutionalization, which is speaking the language of investors. Information gaps. There may be a lack of knowledge of the risks, a lack of knowledge by investors of the risk to nature from industry organizations or projects. So, of course, there's the ethical element of this, which is important, but investors also run a reputational risk that they need to understand. Stories of harm from nature from their portfolios may affect share prices. Importantly, risks from nature to businesses or assets are less understood. This could include pest outbreaks, bushfires, desertification, rising water levels. So here we have an opportunity for governments or industries to set norms or mandates around disclosure of these risks. So I would direct you towards looking at the Task Force on Nature-related Financial Disclosures, who are providing some needed standardization of disclosure. Having that standardization means that then investors can factor in these risks to and from nature into their risk assessment, hopefully incentivizing them towards, I guess, better investments, right, for nature. So we're talking the language here of investors. So that's nearly all from me. I just want to say a final word on investor psychology, which is kind of my interest. While many of us here would believe that nature should be valued for its own sake, the nature of the market is such that persuading market-driven investors requires framing nature conservation and repair in terms that align with their incentivized goals and decision-making criteria. So really we're talking here about trying to be able to measure risk and measure outcomes. And so thank you very much. It's been a pleasure. I'd like to hand back over to Jackie, and thanks again for listening.
Thank you so much, Lucas, for that whirlwind overview of our report. I have put the link to the report into the chat, if you would like to take a look at that. Next, we have Sasha Courville, and Sasha is going to talk us through some practical real-world examples of nature finance at work. So thank you, Sasha. Over to you.
Thank you very much, Jackie, and thanks, Lucas. So my role here really is to provide some concrete examples of nature finance and placing them, I guess, into an evolving landscape. Things are moving and evolving, and so what is true right now will probably not be true in the future. Lucas divided kind of finance into equity and debt. I will be two examples of debt finance and one example of an equity example. And while they come from different organizations, I've been involved in the strategy behind the development of these, so I can provide a bit of context for how they came about and possibly where to from here. So the first one, building off Lucas's point about the importance of public-private partnerships. This first example is a partnership between NAB and the CEFC, or the Clean Energy Finance Corporation. The Clean Energy Finance Corporation plays a key role in de-risking investments for the private sector to join in. So they're largely at the moment focused on reducing greenhouse gas emissions and increasing the flow of finance to the clean energy sector. But it provides a really useful example of a model that could be applied to nature finance. And we're starting to see the CFC extend their mandate a little bit into that intersection between greenhouse gas emission reductions and nature restoration. So this particular partnership builds off a long-standing relationship between the Clean Energy Finance Corporation and NAB. The CFC has partnerships with lots of banks on green finance, that one key area that is going to grow in Lucas's assessment. Now, this particular partnership at the moment includes $200 million, a tranche of $200 million for equipment finance for vehicles, manufacturing, recycling. That's traditional green finance from a lending perspective at a 0.5% discount. But there is also $100 million within that partnership that is for discounted finance loans for agribusiness emissions reductions. And this tranche has a discount rate of 1.15%. So, and in the greater scheme of things, in terms of discounts, over a 1% discount is actually pretty good. And for this program, the finance can be used for a range of activities. So from enhanced fertilizers to reduce nitrous oxide emissions to methane inhibitors and changed land use methodologies. Pasture rejuvenation with legumes that will support nitrogen fixing as an ecosystem service, improving soil health, and reforestation. So while the main focus is on greenhouse gas emissions reductions, these land-based practices can support a broader range of ecosystem services, including biodiversity and habitat protection in shelter belts, for example, improve soil health, salinity management, etc. Now, a key tool that is supporting this partnership in terms of thinking about customers and trying to figure out what could they use in terms of estimating their emissions baselines and providing guidance on potential investments they could make on technologies or practices that can deliver financial and environmental returns is a tool called the Towards Zero Agriculture Pathfinder tool that was developed between the Clean Energy Finance Corporation and CSIRO. And so that they've linked this tool as a way to support farmers understand and think about their opportunities to access this discounted finance. Now, there was a question in the that we received earlier on about why businesses would invest, and here you have an incentive of a reduced interest rate for investments that improve greenhouse gas emissions, which they increasingly need to report on, as well as improving profitability and reducing costs. And here, the ecosystem services benefits are an additional benefit that they get from that. The size of loans in that example, they're expecting somewhere like that they'll range between $1 and $5 million. So they're not tiny. They're actually at quite a significant scale. The second example that I wanted to give is an impact finance loan from Bank Australia, and it's in Kepa Curl, which is the Wurundjeri name for Esperance in WA. And the context for this example is that Bank Australia has a real focus on increasing its ratio of impact finance lending compared to its total lending year on year. And last year, its total impact finance lending was around 19%. So that's comparing its total lending portfolio, which would be, let's say, home loans. And the 19% would be made up of things like finance for affordable and accessible housing, First Nations lending, finance that supports climate and nature outcomes. So in this particular example, ETNTAC, which is a hard to say acronym for the Esperance Dularak Native Title Aboriginal Corporation, purchased a culturally significant property known as Shasta Downs with an existing blue gum plantation on it with an impact finance loan from Bank Australia. Now, ETNTAC has gained significant experience over the past decade with carbon farming operations. They now have close to 5,000 hectares under carbon farming operations. And so what they're doing is they're leveraging the carbon market to create a range of economic opportunities for traditional owners and restore the property to resemble surrounding bushland. So this particular project delivers biodiversity co-benefits as well as First Nations cultural heritage and economic benefits. Now, kind of building off of Lucas's presentation, I think that the key from a bank perspective is that we're going to start to see more and more of these kinds of transactions. They will grow over time, but they still are quite time consuming at the moment to put together. They are more complex. They're different than what banks normally lend money to. So in this case, the bank really needs to understand the borrower as well as the various details of the loan, including in this case, understanding carbon markets, to be able to understand and get comfortable with the risk associated with the deal. More broadly, Bank Australia is working to grow its lending in this area, so to conservation organizations as well as First Nations groups that are protecting country. So they're currently building that capability kind of transaction by transaction, right? So, this will grow, but it does take time to build it and get comfortable with the risk particularly. In the third example, this is a little bit different. It's the equity example. And it's in its early stages, but I thought it'd be useful to flag this as something that will grow over time. It involves an asset manager active in Australian agriculture. In the investment universe, asset managers invest money on behalf of their clients or asset owners in assets or a portfolio of assets. And then they also oversee the management of those assets with an expectation of returns over time. So you may know of New Forests, which is a leading timberland, or in kind of investor language, forestry, asset management company that continues to push boundaries on sustainable finance in the forest sector. New Agriculture is its agricultural subsidiary. New Agriculture has a sustainability to regenerative outcome strategy that's aligned with its investment strategy to drive nature positive and climate positive agricultural systems that will be more resilient in the face of climate change already baked in, while seeking to deliver enhanced returns over the long term. So that's their intent. That's what they're trying to achieve with this. I was lucky enough to work with them on their strategy and in the development of a core set of outcome metrics across a range of areas, including biodiversity, water, and soil health, to bring the strategy to life, to guide practices on the ground, and track progress over time. And as an asset manager, the metrics will also help guide future investment decisions, and they'll help to communicate performance over time to their investors. This example shows that nature and biodiversity, among other ecosystem services, is increasingly seen as important for long-term investors, especially those who are in sectors where nature plays a key role in managing climate risk and strengthening resilience. And that one of the frameworks that Lucas mentioned, that the TNFD, or the Task Force on Nature-Related Financial Disclosures, really does bring, I guess, the investor universe into focus more on nature. And it provides tools to help them assess their exposure, their risks to nature, and then how to reduce those over time. Thank you very much. I'm going to hand back to Jackie.
Thank you so much, Sasha. Thank you so much, Sasha, for your presentation. That was really helpful to get some practical examples. Sasha, just if you wouldn't mind, just in the chat, there are a couple of questions around giving some links to some of the examples that you gave. So if you wouldn't mind jumping on there. Our final speaker is Simon O'Connor, and Simon is going to provide a big picture overview for us and bring everything together. So over to you. Thank you, Simon.
Thank you greatly, and lovely to be here as well. Thanks, everyone. Yeah, I have to tie it all together now. So I guess what Lucas set out so clearly is this great elevated need for additional capital or finance to go to support the protection, restoration and maintenance of nature and our natural capital assets. And this now is embedded in a international convention through the Global Biodiversity Framework that targets 30% of land and water being protected by 2030. So this can sort of set us a bit of a goal and an objective in terms of how much capital we need to see flowing in addition to where we're at today to protect these assets and restore nature. And I come at this from the assumption that the government's not going to fill that gap by itself. And so we're going to need to find ways to attract private sector capital to invest increasingly in nature protection and biodiversity. What I think though is we have a really significant challenge in front of us to construct nature in a way that is investable to private market investors. And by definition, private market investors need to see a return, a financial cash flow or return or revenue generated from the investments to pay back their investments. And this is what's really hard. And as starting my career as an environmental economist, I know very clearly, and you all do as well, that natural assets have a very real value, both a value in and of themselves, but also an economic value. So if we think of wetlands that are nature's way of storing water, of cleaning water, of providing habitat for species that if we lost them, we would otherwise have to invest in concrete and pipes and storage facilities with very real monetary costs imposed by them. Likewise, watersheds, we know that mature forests clean and provide greater water flows into watersheds and water reservoirs than regrowth forests that will consume more of that water, for example. But in economics and in our economy, we're very bad at pricing that. We have always been incredibly bad at pricing it. So what we're trying to do here is put some monetary values around that and to realise the value that some of these assets are providing for us. Where I have probably spent most of my last 10 years is working with institutional investors. That is our superannuation funds, our big fund managers that are sitting out there managing all of our retirement savings over decades for us and protecting that in a way that we will all be able to be paid out when we hit retirement and we can go on our holidays and go and visit this lovely natural environment that is our country. And so we want them to protect that well. It's a real challenge. And I guess what I'd say from an outset is whilst there is a huge pool of capital sitting there in our superannuation funds, at the moment, very little of that is flowing directly into nature protection, restoration or maintenance. And we're at a very early and nascent time in terms of being able to connect those private capital markets, the institutional investors and nature projects. But I do want to refer to a few policy opportunities that can unlock some of that private investment and add to Sasha's examples with some other areas of where we're seeing real activity that is connecting that private capital to nature and improved nature outcomes. Probably though, I'd say this is hard, and Lucas's report really shows that. It's hard to do what we're talking about here, and probably just to clarify very much is, where the big pools of money have been flowing into nature protection have been government funds, but also have been philanthropy. So when we see our very large and brilliant nature conservation bodies, the conservation trusts that we have in Australia, such as the Bush Heritage Trust and others, it's largely based on philanthropic funds that have allowed them to buy up and protect and restore and look after beautiful natural environments and ecosystems. But we're going to need more than just philanthropy and more than just what the government can provide. What is the great challenge is finding what is that revenue stream, the payback to investors who are going to be investing private money that need a return and indeed are obliged under law to generate a return from their investment. So our superannuation funds cannot by law be philanthropists. They have to generate returns or they'll be falling in breach of the Superannuation Act and the regulator will quickly be on top of them. So what we're starting to see in some of the examples that Sasha gave there is where those revenues are likely to come from. And much of that will come, and what we're seeing in terms of the early stage investment in nature and nature finance comes ultimately from the carbon markets. So an investment in the protection of nature, environmental plantings, restoration, that will seek to generate returns through the production and sale of ACCUs, which has been really underpinned a lot of the early green investments, nature finance investments, such as Sasha's example. Another example I'll probably give you straight away, which adds to this, is a good example of how we might see an extension or a ramp up of some of those private conservation efforts, such as the Bush Heritage and Greening Australia and many of the others, Australian Wildlife Conservation and others around, is by an example by Greening Australia, who have partnered with a fund manager called Conscious Investment Management to buy up a new property, which is and will be replanting that through the expertise of Greening Australia, the way they manage their properties. This is a property on the Monaro High Plains in southern New South Wales, just out of Canberra, and will generate returns for the investors in Conscious Investment Management through the production and sale of ACCUs, of carbon credits from that property. That same partnership has just recently purchased a second property and will continue to expand that. Conscious Investment Management then have established a fund, and they're trying to raise capital and attract investors into that fund. I think what this shows us is there's the ACCU market, the carbon market, is reaching a point of maturity where effectively investors would say it's becoming more investable. We have more certainty and confidence in the forward moving price of carbon credits in the Australian market, and we'll make a long-term investment based on that being the core forecast revenue stream from an investment like that. The other couple of examples that Sasha gave, one of which relied on ACCUs as well. Lucas mentioned earlier the nature repair market. This is a really very early stages, brought in the last term of Parliament, currently undergoing the process of setting up the methods that will underpin that to produce biodiversity certificates that will be a tradable and saleable security effectively. Some of the work I've been involved with the Nature Finance Council, which was a council advising the Minister for Environment under the last Parliament. It's a council that still exists, and was really the opportunity brought to bear by a stapling of ACCUs, carbon credits, and biodiversity certificates to demonstrate co-benefits, where you may be able to sell an ACCU at a higher level if it has biodiversity co-benefits as well. And how do you effectively bring those markets together and staple them to improve and incentivise carbon credits that are protecting and enhancing nature and biodiversity? So there's real opportunity through that, and there certainly has been a live discussion as to how that could be addressed. A lot of the other forms of revenue streams that are underpinning nature finance or nature investments or lending really comes back to agriculture, sustainable agriculture. So it's effectively private finance being used to help support agricultural businesses who have demonstrated and able to verify that they're undertaking activities that are protecting, restoring, managing biodiversity and nature on those properties. And so we see some pretty significant amounts of investment in sustainable agriculture. Certainly Macquarie Bank's all over it and really understands that really well as an opportunity in some of their large pastoral leases where they're enhancing some of the soil carbon outcomes, environmental plantings, etc., as part of that. And so probably one of the mechanisms that Sasha referred to that will continue, I think, to help progress this ambition of getting more private finance into nature, albeit slowly, is what was referred to before the Task Force for Nature-Related Financial Disclosures. Effectively, this is a means by which we can reveal and more transparently disclose nature impacts and dependencies. What we would expect is that there will be a requirement in the future for large companies to disclose their nature-related impacts under the TNFD framework, just as we've seen recently legislated climate disclosures for Australian companies under the ISSB framework. So currently the International Standards, Sustainability Standards Board are working on the next iteration of their required disclosure standards and considering biodiversity as part of that. Now, this doesn't necessarily result in more investment going into nature finance, but what it does do is it exposes poor practices or damaging practices. It allows an investor to sit there and look across the portfolio of companies they invest in and see which ones are better or worse. And the theory is that it starts incentivizing capital flows towards those businesses that are protecting and enhancing nature and away from those that are damaging nature. So it's kind of an indirect measure that could increase flows to nature finance effectively. So what we will see, though, is a lot of it, and as Lucas's research shows, is a lot of the opportunities for private investment in nature protection and restoration will come through companies themselves looking to protect nature on the assets that they manage. So an example of that, for example, and this may sometimes be considered climate adaptation, when the Brisbane Airport built its latest additional runway, there was a significant investment in the protection and enhancement of the mangroves around that, as well as the runway being built about 2 or 3 metres higher than it required, based on a climate adaptation, seeing the mangroves as a protection against Moreton Bay and future king tides, tidal events, climate-related weather events that could threaten that asset. So we might see these indirect sort of corporate investments in nature in ways such as that. What has been really interesting to observe is this emergence of fund managers, specifically setting themselves up as green fund managers, climate fund managers, or nature fund managers. And most of them are starting to explore and make some investments in these areas. I think we're at a really early stage, but it's just an interesting observation over the last probably 2 to 3 years. There's probably 4 or 5 fund managers who have established themselves in Australia as environmental, nature, climate fund managers, and they're all looking at these opportunities right now. And so a lot of the very smart finance heads are now being unleashed to see where are these opportunities to generate really the co-benefits of financial returns plus nature returns or improvements in nature or climate. New Forests being one, Conscious Investment Management, Bank Australia through their lending, Woolamai Capital is another one in the market as well. Probably the additional big opportunity for large amounts of private capital to flow into nature finance really is through the means of sovereign bond issuances. So when the Australian government issues a bond and investors invest in that bond. And so in the last couple of years, the Australian government has set up a green bond framework. And within that framework, they have set out explicitly a category that can be funded from those bonds of environmental improvement projects. So the Australian government has issued around $7 billion worth of green bonds issued by the Australian Office of Financial Management. And it shows that to date, around 18% of that $7 billion has been invested in to improve environmental outcomes as a category of the proceeds of where they're using that money. Effectively, the government is raising money from private financial markets to then invest in and deliver some of their programs. So, for example, money has been spent through that through a Saving Koalas Fund, through an Urban Rivers and Catchments program, and through some Murray-Darling environmental improvement programs, for example. So just to say, this is from a private investor, including a super fund. It's very easy for them to invest in an Australian government bond, be it a green bond or non-green bond, plain vanilla bond, because it's seen as an investment grade risk. It's a healthy, the Australian government is underwriting that. And so this is a good way to see private capital flow through to delivering nature outcomes. I guess I'll just conclude by saying none of this is going to be very effective without really strong environmental laws, and by starting off by preventing the harm that is still unfortunately occurring here by weak or ineffective environmental laws. So really underpinning this is the need to continue to progress our improvements of the EPBC Act here. But I think these need to run in tandem. But I do think some of these large global commitments, such as the GBF, the Kunming-Montreal Protocol, the commitments made through that will really and are currently really sharpening the minds of finance to see what role can they play in terms of more capital flowing to protect nature and to drive these 2030 targets and beyond. I think that's probably sufficient from me, so we can move on to questions. So Jackie, thank you very much.
Thank you so much, Simon. I might ask actually all of our speakers if you wouldn't mind just popping your cameras on for our Q&A session. Lovely, thank you so much. Right, so we have been having some very curly questions, I think, popping up in the Q&A. So we might start with. Here's a curly one, possibly for you, Sasha, or for Simon. How is climate risk considered in biodiversity offset provision projects? So this is a question from Grace. So more specifically, as an example, if a bushfire wipes out a conservation area for which credits are issued, how would that be considered and how would that impact on the issuer? So you've got your credit set up right at the beginning. So what happens if there's an environmental disaster? Not sure who'd like to take that one.
I'd love Sasha to take that one.
Thank you. It is a real risk, and it is something that needs to be thought of at the very beginning of the project assessment from a risk management perspective.
So actually allowing for the potential for disasters to actually be, I guess, priced in, for want of a better word, into the instrument.
Yeah,
Okay.
and I mean, it would also go towards thinking about investments in a portfolio of assets that are spread across regionally so that you're minimizing your risk as well.
Because generally these are set up in a way where there's provisions under these acts around permanence and the maintenance of permanence over time. And so there may be that you relinquish those credits if that occurs, or that there's a so yeah, it can definitely have an impact on that. So hence the portfolio approach being a useful one. Yeah.
So Simon, at the end there, you spoke about the need for strong kind of legislative support as well. So an interesting question came in as well, which was asking about specific protection as so, for example, protection under the International Union for Conservation of Nature. So where you've got land or sea that are specifically protected areas. And so the question was, how effective is it to perhaps look for solutions from financial markets as opposed to having more of those, dare I say it, sort of real conservation frameworks or protection put in place? So would you like to speak to that a little bit?
Yeah, I mean, I'm really aware there's some incredible experts on this call who are going to know some of this better than me. So I'm just going to be really conscious of that. But I think what's really important is that when you're going to unleash finance on this topic, let's make sure there's some really rigorous science underpinning what's important, what's rare, what's unique, what we need to protect, what we because and that is. Right now, although there is data everywhere on environment and science and ecosystems and biodiversity in Australia, it's quite hard for a finance person to navigate that data right now. And so one of the interesting initiatives of the last government was putting in place the Environment Information Agency. And I need to double check whether it actually ended up being legislated or not, but it got pretty close and it may have fallen over like the EPBC Act reforms. But that was a really important step to say, let's bring together all the information and data we have to ensure we know what the most special, unique, rare ecosystem species are, and that we can coordinate that with the way finance is operating and where corporates are acting in the country. So I think it's both. We actually need to understand the really endangered stuff that needs greatest protection. And I really am so impressed by the work of the big conservation trusts and how brilliant their science is in terms of identifying those ecosystems and species around Australia, and the effectiveness that they've had is enormous in terms of protecting really, really unique and precious ecosystems. So I think we have to be cautious that finance is not going to be the white knight. We need to manage finance. We need to manage them carefully, and we need them to be informed by science and scientists and all the experts on calls like this, and not just unleash them to this, because I think that's the risk here.
Yeah, we actually need everyone. This is a wicked problem, right? We need everyone contributing. Thank you, Simon. Possibly one for you, Lucas. A little bit of a curly one, which might be of interest. What is the psychology of investors in relation to terminology? So this terminology of nature. So it seems like an externality to human survival. Could we instead talk about the survival of the human species? Life on Earth will continue, but human will not with the current trajectory. Would you like to tackle that one, Lucas, perhaps?
Yeah, okay. So we're talking about existential risk. I don't know if it will play super well with the kind of finance people. I don't know if that's the I guess if you're on the, let's just say, politically a little right or center, you're going to see that as just bleeding heart liberals. And again, I'm thinking here from a strategic point of view, not necessarily a truth or not. And I think that it's probably more helpful to speak in the language of investors like we've been talking about today. But I would say that that there are issues with language and issues with what all of these terms mean, and that is a big issue, and not just for just at every level. So what's no net loss? What's net gain? What do these terms mean? There's a lot of double counting in the figures for, what's the difference between natural infrastructure, payments for ecosystem services, and credits, and all of these things are interdependent, and you can use an offset to do payments for ecosystem services. You can invest, so it's just so complex. And so more of this is important, right? More, and Sasha, I think your hand is up there too. So I'd be happy. Was that a hand I saw? I was
just to add
looking
something.
at the camera. Yeah. Go for it.
Sorry. I think from a language perspective, with the financial sector, I think one of the key challenges is around time horizons. Banks, it's a quarter, right? Like it's so it's 3 months that you're looking at in terms of the returns, whereas we're actually talking about things that are 10, 30, 40, 50 or more years. And so it's really being able to understand and match the issues to the time horizons and get investors and the finance sector more generally to think more in the long term. The other key element from a language perspective to use with the financial sector is around risk. And Lucas, you articulated that really, really clearly in your presentation. Nature is a key defense and a key protection against climate risk, and we're starting at the very beginning to understand that and to start to quantify that and link it into how the finance sector thinks.
Thanks, Sasha. There's just a question that's popped in that's said, are there any differences between nature finance and green finance? Again, this is coming back to terminology. I might try have a go at that one, and I'll see if there's other thoughts on the panel. I think green finance is a much broader term. I would say that historically, and please correct me if I'm wrong, historically, green finance has almost been climate only, I think. But I don't know if that's because we only started thinking about climate, and then I would say nature finance is specifically actually more to do with biodiversity and ecosystems. Sasha, I know you had we had some discussions earlier about nature and biodiversity and green. Do you have any thoughts on that one?
No, I think I would agree with your assessment, Jackie. I mean, green finance, in some ways, green finance was the first kind of thing that was framed up, and then it went into kind of sustainability or sustainable finance. So green at the beginning kind of covered a lot of things, but the overarching frame, and if you think about taxonomies at the moment, you're largely talking about, at the moment, green would cover everything environmental, but the overwhelming majority of that is in climate, largely mitigation, so emissions reduction.
Thank you. So there was a question also around kind of extending out to also incorporate sort of societal issues as well. Simon, you bandied this word co-benefits around. So I was wondering if maybe you could talk a little bit more into that and how kind of packaging up products could work or could help to address several different issues.
Yeah, and the co-benefits that I was referring to there was mainly just saying that, how do we differentiate in a market that one ACCU is not the same as another ACCU? Like one's made from replanting a monoculture of trees versus one that's replanted a forest with a mix of species, and one is really aligned to the local ecosystem and supporting improving that, and one may not be. And so I do think, so probably where this conversation, is heading in many cases is, is really where does this intersect with communities, and in particular those examples like Sasha gave of actually, you know, First Nations peoples and lands of First Nations peoples, and how do we do this in a way that's culturally sensitive, bringing in cultural land ownership, which I think is a fantastic example of sort of ticking multiple boxes. And so, you know, that's where we'd really like to see the multiple benefits and stacked on top of each other. I think at the moment there is a little bit of a differentiation in the carbon credit market. You can buy gold standard and voluntary carbon certificates, etc. So, you know, that's all sort of a voluntary thing to date. But I think there is an opportunity to sort of build that out as the market matures.
Thank you. Thanks. So Anne had a question. From the perspective of investors, have there been questions or hesitations around the scientific rigor and land management strategies used kind of in financial instruments? Or is it predominantly the risk of returns or other financial considerations? I'm going to jump in with my academic hat on. So I think academics are possibly the most critical, and certainly the academic discussions have been a lot around scientific rigor and really, you know, benchmarking correctly and that kind of thing. But Simon, it looked like you wanted to jump in there about concerns around scientific rigor.
Yeah, look, all investors right now are paranoid about greenwashing because you've got the regulator who's suing people for greenwashing. And so absolutely, people are trying to work pretty hard to make sure there's credibility. And it probably actually is deterring people from making too many claims. But yeah, I think that we do have a sector that fundamentally, finance people don't know a thing about the science of ecosystems biodiversity, though. So there's a steep learning curve, and we're needing to bring two worlds together who don't usually talk and to learn a language. So I think there is endeavours to understand and what is a rigorous scientific approach. But Sasha, tell me your views, because you had a nod there too. You might be more cynical than me.
No, I actually think that they go hand in hand, right? Like the scientific data, and especially the evidence base, right, is critically needed to actually be able to price risk better, right? So when I was in NAB driving their natural capital strategy at the time, and this is going back many, many years, environmental data sets and financial data sets were kept in silos and they weren't talking to each other. So it was impossible to actually understand the financial consequences of environmental decisions and management decisions on land, right? So and then the time horizons again of those studies was a barrier. Now that I think we're thinking in a much more integrated way, that's great. What the financial sector desperately needs is large amounts of data of different locations over long periods of time to be able to then factor the real risks that are embedded in that data of poor environmental management in so that they can price it appropriately.
Yes, thank you. I think the data conversation, I think, is at every green finance conference I've been to, the data issue has always come up. Yeah, we're very data greedy in finance, I think. And the more data, the better. All right, I really like this one. Oh, let me find it, sorry. Based on your experience, what is the unintended consequence of this approach, i.e. finance, that keeps you awake at night? I'm going to start with you, Lucas. So you read a ton of research into nature finance. Were there things that you found really worrying from the research that we've done?
Look, it's more a challenge that is set down from our findings, I think, which is really what we've been talking about today, which is the ability to come together as a community to solve this wicked problem. And in fact, it's made me feel quite optimistic in a way that if we can coordinate that between, this really needs to be solved, like we've been talking about, by multiple stakeholders and multiple sources of expertise. And I actually think it's not one for just people in ivory towers and experts, and it really is something we need, that deep understanding of natural environments, so everyone can participate in this to some degree. So I think that that's the daunting task of coming up with these, matching nature, the needs of nature to the needs of investors, right? That's the challenge, but it's also the opportunity. And so, yeah, that's what I would say.
Okay, yeah. Thank you. Sasha, anything that keeps you awake at night?
Well, I mean, I think the question was framed around unintended
it absolutely
consequences.
Was, yes.
We are in such early stages of work in nature finance that I don't worry about unintended consequences. I worry about the scale that's needed to be picked up, with the caveat that not everything can be solved with markets. And markets can play a really important role and a contributing role, but they also need policy, you need other frameworks, you need other tools. So markets are critical, but they're not sufficient, and there are some things you can't price into a market.
Thank you. Simon, how about you?
Yeah, so much. Like putting a price on nature, right, is just so incredibly challenging, and we'll always miss some of the value and the complexity of nature. So I think there's a real hesitancy in this, but also an awareness of the necessity too, because of the challenge that we need and the capital that we need. But yeah, I just think we can't unleash finance without the scientists being there guiding the finance. I just think that's and the other thing is, there's a lot of work going on to the TNFD. I think there's a real risk we come up with disclosures that are meaningless. You know, I consume lots of water and I produce some rubbish, and it says nothing about the biodiversity outcomes, whether they're improving or deteriorating. And so, you know, I'm sort of doing some work to push companies to make sure we're getting that this is actually a meaningful reporting measure that can inform us on the state of nature. So yeah, lots of nervousness. Great question. Thanks.
Yes, thank you. I could perhaps have chosen a happier question to end on, but I think this has been a really wonderful discussion. Thank you so much, Lucas, Sasha, and Simon, and thank you everybody for joining us today. The recording for the webinar will be made available to everyone who has attended today. So thank you so much for your time, and we hope you enjoy the rest of your afternoon. Thank you.
Thank you, Jackie and Ian.
Thank you.
Thank you.
Thank you, everyone.